My name is informational, and welcome back to my channel, My Tax Guy. This is where we're going to discuss all the ways that tax planning and getting a little demystifying the tax code can benefit you and help you in your regular everyday life and help you meet a lot of your financial goals. Couple of quick housekeeping things. Once again, I want to thank everybody who is subscribed to my channel. I want to continue to have people subscribe. I want to try to make it to 1,000 subscribers by the end of the year. And with your support, I'll get there. So feel free to like and share, hit that subscribe button down below, and let's keep making the channel grow. Now we're going to get into one of my favorite topics, which is the W-2. Now, I did talk a little bit last week about that. I did go over a lot of different things that are kind of issues as far as like taking care of your W-2 and how it's kind of too late at the time for you to do your taxes, for you to correct a lot of those things. So what I like to do today is just talk to you briefly about what I like to do called a mid-year audit. Now, that mid-year audit is nothing really spectacular or crazy or something you can't do. You're basically just going to go over your pay stubs. That's right. You're going to take your last pay stub and you're going to look at those certain things to see if you're heading in the right direction with your withholding, or if you need to make a change so that you can have a season where you're not paying back so much, so to speak, or that you're actually going to end up getting a refund. Now, a lot of the times what people will do, they'll go past this time of year and they'll think, time for vacation, or it's time for a little bit more family vacation wise. Sorry for the noise. Fire department keeps coming by here. What can I say? Office can get crazy. But this is the time where people kind of like on vacation and they're just not really focused on it. That's not their thing. But this is really the time that you probably want to spend maybe 15 to 20 minutes, maybe even an hour, really looking over your pay stub and seeing what adjustments you need to make. And I'll give you an example. Now, a rule of thumb with most people when they do the withholdings is this 10% rule. Once again, that doesn't really work after like $50,000. A matter of fact, it really becomes a problem if you're really only doing 10% at that point, because as you make more money and with other certain things, like if you take any sort of withdrawals from things like 401ks and stuff like that, all of that stuff comes into play. So that 10% rule doesn't always fly. So just want to put that out there. But it is a good rule of thumb. It's not actually the worst rule of thumb. It's just it doesn't work for every income level after a certain dollar amount, especially after like 40, 50,000. It gets really tricky as far as like what you can expect, including in some cases a tax balance. It's scary sometimes out there. Now, what you want to do when you look at that pay stub is you want to make sure, or at least try to get as close to that 10% as possible. Now, with the withholding rules the way they are, your employer, depending on how many, especially depending on the hours that you're working, you may not be able to just solely depend on that withholding status to have enough taken out. Prior to 2016, if you, for instance, you put a 0 down on your tax, on your W-4 tax withholding statement, your certificate, if you did that, the most amount of money that could come out will come out. However, with the changes being done to the not just the W-4 but to the withholding tables, that all changed. So it's no longer like that. You can put a 0 on there, and depending on which filing status you pick between single, married filing separate, married filing joint, and head of household, between those three things, you can literally put a 0 in there and may not have enough to take care of it. One of the things I like to tell married people is, especially if they find themselves with not a lot of assets, but they find themselves with a good amount of income and not a lot of assets to help offset some of the tax burden, is that they need to make sure that they're not putting down joint, because if you do married filing joint, they'll just assume that one of you guys is going to have the money to pay the difference. So that's one of those things, like when you're looking at it, you're like, you might be better off just leaving it as single, married filing separate status, and that way you won't really run into that issue. So that's one of those things like you'll have to look at. So that's just a quick one where you say, hey, is this married filing joint thing going to work? And if you're married filing joint, of course, you don't want to do this audit thing by yourselves. You guys need to come together and spend some time looking at some stuff. Just doing some quick look over, like, hey, this is what we have together. This is what it's going to look like, ABC. Each filing status of all the filing status have their own like withholding rules, withholding tables, and even when you do your taxes, there are different tax calculations depending on your status. So it's really important that you look over those things and that you say, hey, if we're going to do this married filing joint, we're going to do just, if you're just single, whatever the case is, that you're looking at, make sure that your taxes are there. And if you don't have the amount of taxes that there, that you make whatever adjustments you have to make. As far as like the property owners, property tax and things like that, just be aware that on your Schedule A, your taxes are cut off at 10 grand. 10 grand is the most you can write off on your federal tax return for state and local. And that's it. Everything else just kind of goes away, and there's no carry forward. Not yet anyway. We're hoping that Mr. Biden would have given some relief for that, but he's not able, so it doesn't look like that's going to happen. So this will be continuation of the same rules. 10 grand is the cutoff. Like, I'm in New York. There are places in New York where there's property taxes I've never even heard of. Like, there's a school bus tax I found out about. I have a friend that lives all the way out in Roosevelt, and he was telling me about that. I was shocked. You know, he doesn't have children, but he has to pay this tax. It's a local tax he has to pay, and it's about 13 grand. So it's quite a bit of money to be paying out of pocket. And prior to 2017, he could always count on being able to write that off. But no longer. He's no longer allowed to take his deductions beyond the 10 grand of state and local. So he's kind of just stuck with whatever withholding he has really coming out of his paycheck that counts towards that. So that's pretty much all he can get. So that state and local withholding thing, even the other taxes, you're capped at 10 grand. So that's all you're going to get out of it. So you really have to look at the mortgage and stuff like that, and making sure that your payments are in and that you're all there as far as like the interest and stuff like that. The mortgage interest, still the limitation is, if I'm not mistaken, it's still around 1.1 million, might be 1.4, so that you still are going to get a great benefit from the mortgage. So as long as you're paying your mortgage basically, and you can still take as much as you like on that. The last part about looking over your financial in the middle of the year, your financials, is you have to look over like any of your stock transactions and things like that. Those things get really, really tricky depending on what you're doing, as far as like if you're somebody that's actively trading versus someone who's just like kind of in there, kind of not in there. You know, you have some friends that may give you a tip. You may have some friends that don't give you a tip. So you just have to keep an eye on what you're doing exactly. One of the things the IRS has been cracking down on is cryptocurrency. People don't seem to understand that stuff has to be reported. Those transactions must be reported. My basic rule of thumb, and this is very simple: if you are getting a form, there's a reason for it. Please file it. Okay? So it's not something you can ignore. When crypto first was coming out, especially with crypto and blockchain and all the digital currencies and things like that, a lot of the things that was going on was sort of like the Wild West. The IRS really didn't have a way to really handle that. And that changed very quickly. They caught up very quickly to that. So a lot of the things, maybe some people are saying like, oh, you don't have to worry about this, you don't have to worry about that. Like, no, it's just like it's going to be treated just like any other types of investment. You will get a form at the end of the year. If you're selling it, if you buy it, no. If you're selling it, yes, because at the point when you sell it, that's where they say that whatever it is going to be is going to be. If you're selling it for less than what you bought it for, of course, the loss. There's other rules in there, by the way. But if you're selling it for more than what you gotta, of course, report the gain. The loss is a little bit different because there are holding rules. There are certain rules. If you don't hold it long enough, but you still try to sell it, they can disallow the loss, so you won't be able to take it. So you got to keep that in mind as well. If I'm not mistaken, it is 30 it's 30 days. You got like a holding period of 30, and then another 30 days, another 30 days after. So basically it's 60 days. Basically, if you buy it, any sort of crypto or stock or anything like that, you basically got to hold on to it for 60 days. If you sell it and you sell it for a loss, they will disallow the loss and you won't be able to take it, which is, in some cases, some people are actually looking for that loss. So it's kind of a hard thing to come by. So you just want to make sure that, you're looking over your stuff. Don't wait till the end of the year. I know it's a lot of different things that I'm saying to you, but the gist of everything I'm saying is don't wait until the end of the year to start looking at this stuff. November and December is too late. Really, I would like to say pretty much once you're done with your taxes, give it a month or two when you're planning out the rest of your summer and everybody want to go out and enjoy yourself. That's when you should be really looking at what's going on with your finances. Don't be afraid to pick up your W-2, whether it's just you by yourself or you with the spouse, even you with the friend, and really look at that thing and make sure that you're going forward with everything that you need to do, and plan for the future. That being said, I want to thank you guys for coming in, and I appreciate having you. Next week, I will probably be wrapping up the rest of my financial audit series as far as talking about like W-2s and things like that and what you should be looking for. I'm going to start talking more about some deductions that people can take that is a benefit to them, both for federal and state. Thank you again, and you guys enjoy the rest of your day.